Welcome to the Single Source podcast, featuring fund managers at the forefront of private markets.
I'm joined today by Matt and Kevin Hamilton, co-founders of AetherStrike. AetherStrike is the platform that tokenizes in-ground commodities. Please explain, how do you do that? How did this come about?
Matt and I were talking about some of the challenges he has in his oil and gas role, and we were talking about my background in crypto and thought there's a real opportunity to tokenize in-ground commodities. So when we say in-ground commodities, what we're talking about is an oil field that is literally in the ground, or a gold mine that hasn't been mined out yet. So we're talking about commodities that are actually still in ground that need to be extracted in some way. And when we talk about tokenization, we say we put the real in real world assets, and that means we are actually tokenizing things that are in the ground, not pieces of paper like securities or money market funds, but actual commodities.
Elaborate on that a little bit more. You mentioned a dynamic reserve resource unit, DRRU. So what does that token actually represent? How does an investor realize value or returns over the life of a project?
Our DRU is a security token, and it represents a one-to-one match with that in-ground commodity. So whether that's a barrel of oil, an ounce of gold, a standard cubic foot of natural gas, it is a match for that. And it represents the net proceeds from that recoverable reserve. The biggest value driver in our tiering structure is for investors to come along early in the journey. It's very hard for investors to get exposure early in pre-production projects. So that tier compression and really coming on the journey from a discovery to pre-production to production, and when they buy at a discount, a properly priced discount, and move up through the tiers, I mean, that's really a significant value driver. As an example, our first strike is Asphalt Bluff South, which is 20 million barrels of asphalt binder in Utah. And so we are tokenizing that in a one-to-one ratio for each of those barrels.
Of all the real-world assets being tokenized right now, AetherStrike has focused on evaluating non-producing natural resources. Why non-producing? Can you give me an example?
Yeah, we chose non-producing because that's where we saw the biggest gap, really. I sit on the producer side, and so I see various financing mechanisms that come across my desk. And there are ways to do it, but each of them has their various obstacles. Private equity wants control, venture capital wants a quick exit. None of those really work for a commodity that's been discovered but has years until it's actually producing. So we came up with this new strategy to really fill that structural gap for a long production cycle.
And when we're talking about these tokenized type of commodity reserves, they're different from a crypto asset. Kevin, you told me that when you talk about the risk profile, but why are they different? What protection do investors have to minimize that downside risk?
I've been in crypto since 2012, so I've been through bear markets, winners, bull markets, and these are fundamentally different than a traditional crypto network or utility token. One of the biggest differences is that the floor of a traditional token is zero. There is no true floor, whereas for our tokens, the DRUs, the underlying asset is actually what the token represents. And so the floor is the net asset value of the commodity in the ground. So if we're tokenizing an oil reserve, your token is backed one-to-one with a barrel of oil in the ground. And that is the fundamental floor of our token.
Matt, in terms of allocation for our LPs on our Apex Invest platform, if you're already exposed to traditional commodities or private energy, where does this position fit? Is it a substitute, a complement, or a different category entirely?
It's certainly a complement, maybe edging into a different category. But right now, really, there's two main ways that your allocators can get exposure to these similar type of structures. That'd be through a futures-based commodity ETF, where you have additional costs and really limited ability to focus in on the asset you want, or a private energy play, where you can focus in on a specific asset, but you have a long lockup, limited liquidity, and a higher cost structure. So we really feel like we sit in the middle. Our offering allows you to have a direct exposure to a specific commodity reserve. You know exactly what asset you're picking. This first strike, you'd be picking a bitumen reserve in Utah. The closest analogy really is a royalty trust, and a lot of allocators have that in their sleeve already, or at least familiar with it. So the DRU actually starts to feel more familiar when you compare it to a royalty trust, which gives you fractional ownership of the production proceeds, but not equity in the operating company, which is very similar to our structure. Our Drew structure with its liquidity, which will be building a secondary market, but the rails are already being established, and a leaner fee structure based on how it's configured. We feel like it's a nice complement against these other existing structures.
Thanks for listening. For more, visit apexinvest.io.